I'm joined by Gary Boyson. He's a portfolio manager at Rand Swiss. Thanks for joining us, sir, as always.
Thanks for having me.
Good stuff. Global markets looking a little bit wobbly today. Of course, we did see the all-share index also starting off on a back foot, but it has since improved with financials dragging it down earlier. So is this the beginning of a sort of calmer market situation as we go through December?
Yeah, so potentially. I mean, we obviously saw, the US shopping season kicking off last week, and the US markets were open for half day. So I think a little bit of the volume has come out of the market as well. Overseas markets that hit record highs, and a little bit of a pullback in Asia this morning. Perhaps a little bit of buyer's remorse from what everyone did on Black Friday. People selling shares to go and pay for their purchases. But seriously, I think it's a very natural correction that we're seeing today, and we're seeing also a much firmer rand as well, despite the ratings downgrades, and that probably taking a little bit of a shine off the big heavyweight rand hedge stocks, and that perhaps stabilizing the market a little bit.
But what's the explanation for that? Because everyone was really worried, oh my God, there's going to be a massive capital asset sale on the Johannesburg Stock Exchange, and we're going to see the rand plummet. So why has the opposite occurred?
But if you look at it again, there was very much an argument to be made that the rand had already priced it in. So we did see a movement on the rand from 12.80 to 14. That's a significant movement in terms of the currency. On top of that, we basically had three scenarios with the two ratings agencies. So we had either both were going to downgrade, one was going to downgrade, or we would get no downgrade. So we hit the middle road scenario, which I think most people were expecting. S&P normally does lead in the decision. So the fact that S&P moved and Moody's, remained, left us at investment grade, I think was expected by the market. And now you're just seeing the risk premium coming out as well. You've also had an announcement out by the presidency this morning that they are, want action from Treasury on potentially 25 billion rands worth of spending cuts and an increase of about 15 billion in taxes as well. So that, I think, also the market has latched onto that a little bit more optimistic. Government showing that they are taking the comments by S&P seriously. Whether this is just populist rhetoric or whether we're actually going to see this coming through remains to be seen. But certainly the market latching onto it, and we're seeing slightly more positive rand on the back of that. And I think we're down to 13.76 when I looked at it last.
Okay. You've kind of jumped the gun a little bit, but it's allowed. But now, when we look at our local markets in terms of the bond market, which is very significant for what happened in terms of the ratings, the yields rose, and that was to be expected. Do you expect that to be a continuing thing? Yeah,
again, I think, the yields, yields on our bonds, have been pricing in a downgrade for a while because, when you go and sell bonds on the open market, despite what a ratings agency says about your government debt, it's what the actual investor is willing to pay in terms of funding you. So that's kind of what determines the price as well. And that you can see has been moving out, as you can see, I think, on that chart on the screen at the moment. The bond yields have been pushing out for a while, and that is the market pricing in the expectation that the ratings agencies are going to downgrade. They're pricing in, what kind of risk premium you have to attach to lending money to the South African government. So that very much was already in the market. Now, what's happened in the short term is we got those announcements very, very late on Friday, just before global currency markets moved, and you suddenly saw this knee-jerk reaction on the rand, where it spiked out to 14.15, and then currency markets closed. So I think you're now just seeing the market starting to digest that. You're seeing the currency get a little bit firmer. I wouldn't be surprised to see bond yields strengthening as well. So yields actually coming down a little bit, especially after the announcement from the presidency this morning. So I think that just really settling market nerves a little bit. And as we've said on this program before, in the past, when other countries have dropped from an investment-grade credit rating to a non-investment-grade credit rating, you often see the currency and bond yields actually improving because a lot of these financial markets are very liquid, and they can price this in ahead of time, and it's all based on expectations. And I think the expectations were met on Friday, and that's why you're seeing a slightly more optimistic picture this morning.
Okay, the key question, and it relates to what you've mentioned about the presidency. What can Malusi Gigaba do in 3 months, basically, to turn the tide around and convince markets and ratings agencies that we've got this, we're in control, and we're going to have a good fiscal trajectory going forward? What prevents Moody's from not downgrading us in 3 months' time?
I think the list is long, and it's quite complex to go through. But certainly, I think the way that Treasury is currently handling the state-owned entities has to be addressed, and it's really also it's the fiscal gap that we're facing. So it's unfortunately we're just spending more than we have, and that needs to be reined in. Also, just to get our current I suppose debt to GDP load under control. I mean, you've seen that debt to GDP number really blowing out, and if that any sort of policies that can be physically implemented to stabilize that, I think would go a long way to assuring the ratings agencies that we are serious and that we want to improve and we want to regain our investment credit rating.
Okay, and let's talk a little bit about bread and butter economics, specifically one company, Tiger Brands, coming out with their annual results for the year ended September. They came out with headline earnings per share up 2%. We do have a chart there, a table there just showing what their performance was. All fairly pedestrian, except for maybe their operating income rising by 11% to 4.6 billion. Cash generated 6.1 billion. That's up 43%. Those metrics, they look impressive, but the revenue and the headline earnings quite pedestrian.
Yeah, it is. I thought a slightly better than expected result. So certainly the cash generated is a fantastic result, and it's part of, I suppose, a more general move within South African companies to really consolidate, and with uncertainty around the political situation in South Africa, it's just prudent to hold on to the cash, to not go and fund acquisitions, to try and cut costs, to become leaner and more efficient operators. So that's why you're seeing those cash flows improving, which I think is positive for the company. What really hurt them was actually a stronger rand. So it was especially in the deciduous fruit business, which is an export business. So that did hurt them slightly. But overall, I think a fairly good set of results. We also saw grain prices coming down, which helped with their bread sales, and that did also help increase their operating margin. I think the operating margin was just over 15%, which is a good improvement for the company. It is obviously operating in a very, very difficult environment at the moment, but I think it's with what it's got, it's done very well, and this is a company that I think is moving from strength to strength. It's something that it's always difficult taking almost commodity inputs and then having to sell them, especially when commodity prices are that volatile. When you're dealing with things like droughts and increasing grain prices, and you have to sell on to consumers at almost a fixed rate, and you have very little pricing power. But still, I mean, they've got 300 brands. They're a very strong business. So I think good set of results from Tiger Brands.
Okay, thank you very much for your insights, as always, Gary. Well, that was Gary Boyson. He's a portfolio manager at Rand Swiss. After a short break, Nzinga has more business news for you.